So in this video today, we're going to be talking about how to invest in 2019. Now, I've done a number of different videos on this topic that kind of talk about how you need to set yourself up for investing as far as, paying off any high interest debt and setting up a cash cushion and all that jazz. And so that's not what we're going to talk about in this video, but if you are looking for that, I do have a complete guide over on my blog, investingsimple.blog. I'm going to link up to down in the description below, and I'll also link you up to a video I did that kind of talks about those initial steps that you have to take before you invest. But what we're going to focus on in this video is more or less the psychology going into 2019, what you need to understand going into 2019 as an investor. And the very first thing I want to talk about is the drastic difference we saw between 2017 and the year 2018 in the stock market. Now, as of recording this, it is December 31st, so we've just about closed out the year. And this is pretty much what we've seen over the last 2 years from the S&P 500. So 2017 was a year of euphoria. It was essentially a straight bull run, and for a lot of people this was the very first time that they dipped their toes into the stock market, and unfortunately it gave a lot of people very unrealistic expectations when it comes to investing and what they should be expecting out of the stock market. The stock market is not simply something where you throw your money into it and then automatically get a 10, 15, 20% return, in 1 year. That is just not realistic. And unfortunately, a lot of people have a clouded judgment as far as what to expect from the market. And so we saw this bull run that was largely a result of, corporate tax cuts, and that resulted in record earnings, and pretty much everyone was in this massive state of bliss and euphoria. And then pretty much as soon as 2018 rolled around, January of 2018, the party was largely brought to a halt here because of the beginnings of the trade war. So these are the things that we have seen happen in 2018 that have led to this insane volatility, in some cases record-breaking volatility. I mean, we just came off of the worst ever Christmas Eve in history, followed by the best day the market has ever seen. So this is like volatility that nobody has ever seen before, and this is largely due to the fact that there are more people than ever investing in the stock market. I mean, services like Robinhood, M1 Finance, all these free brokerage platforms have made it so easy for people to invest. So we're seeing record high participation in the stock market. And second of all, we have, high frequency trading platforms and algorithmic trading and automatic sell points and, stop losses taking place. And so as a result of all of that, we are seeing more and more volatility in the market and more drastic price moves than we have ever seen previously. But these are some of the catalysts that we've seen here behind this massive market volatility. Number one, we are seeing this trade war between the US and China that is largely unresolved. It's pretty much just on hold at this point in time. And we are also hearing about fears of slowing economic growth over in China. And based on the fact that the US market is so dependent on China, it's going to affect both markets. We are also in a rising interest rate environment. We just had our 4th rate hike this year. And we are also seeing weaker numbers from companies like Apple, for example. Some of these companies that were absolutely killing it in 2017 are a little bit more, cautious on their forward-looking guidance here in 2018. And so this is pretty much the landscape right now. And so why are we seeing all of this volatility in the market? It's because of one reason, and that is the fact that the market loves certainty. 2017 was a year of certainty. It was company after company posting record-breaking earnings, great economic conditions, no fears of any kind of trade war, and then in 2018, it's nothing but uncertainty. We have no idea what's going to happen with the trade war. We have no idea what's going on with China. We don't know what the Fed is doing here in terms of interest rates, how far they're going to rise them, and they seem to be caring more about, the economy overall as a whole as opposed to the effect of the interest rate hikes on the stock market, which they should, because you want to look at the whole economy. You want to look at the unemployment rates and all these different factors when determining, whether or not it makes sense to actually increase interest rates. I think the last thing they really care about is the effect on the stock market, because that's just one part of the overall, or one indicator of the overall economy. And so what we have right now is massive uncertainty in the market, and it's being expressed in this rampant volatility that we are seeing. Now, before I get into strategy number one, I just wanted to mention if you guys are looking to pick up a completely free stock, Webull is a brand new free brokerage account out there that has a pretty awesome deal right now. If you open an account with them, you don't even have to fund the account. They're going to give you a completely free stock worth up to $1,000. That's going to be the top link in the description below. I am affiliated with Webull. You guys don't have to take me up on that offer if you don't want to, but that is available to you if you're looking to grab a completely free stock. Pretty awesome offer they have going on right now. But anyways, let's get into number one and talk about the first thing you have to do in 2019 as an investor, and that is to get comfortable with volatility. There is nothing saying that this volatility is going to stop in 2019, and if anything, I see it possibly getting worse because of the massive amount of uncertainty out there. And so if you're not comfortable with the volatility you're experiencing within your stock portfolio or within your investment portfolio, you are probably too far on the right here on the risk-reward profile. And this is something I've actually never really talked about on my channel, and it's a shame that I haven't, and so I'm glad I'm covering it now. But this right here is what a risk-reward profile looks like. The top line here, the green here, is the potential reward or potential return from investment, and this red line here is your potential risk or downside with that investment. So a lot of people are looking for high return investments. They're looking for 10, 15, 20% potential upside or more, so they end up, all the way out here on this green line. But what they don't realize is that by putting themselves out here on this risk-reward profile, they're exposing themselves to all of this volatility and all of this downside risk. So if you found that you just started investing in the stock market maybe somewhere in 2017, and maybe you invested in some, growth stocks or some speculative investments, and you experienced this massive bull run and you were having a great time, but now all of a sudden you're not having such a great time, you're having trouble sleeping at night, it's probably because you are not investing in something that is aligned with your actual risk tolerance, and this is the first time that the volatility is showing within your investments. So what you may want to do is push yourself a little bit further back here on this profile. So maybe you're looking to go for a less aggressive return, but you're also exposing yourself to a lot less downside risk. So just to explain this to you guys, all the way on the left here where you have basically no potential return but no risk, that's going to be cash. That's going to be your bank investments, whether it's a CD, a money market, anything like that. That right there is absolute certainty. And if you want absolute certainty, it comes at a price. And that price is the fact that you're not even going to keep up with inflation and you're going to lose the buying power of your money. Or at best, you're going to just keep up with inflation and have no growth of your money. So that right there is the price for certainty. A little bit further to the right of that, we have bonds. As conservative as you can go would be, U.S. Treasury bonds or, ultra short-term bonds. That's going to be a very small amount of risk, very small potential return there. And then just beyond the bonds, you have your ETFs and your mutual funds. This is people who are out there buying Vanguard ETFs, buying index funds, or they're investing in mutual funds. And rather than investing in individual stocks, they would rather own the broad market and have diversified exposure to the stock market. That's going to put you maybe about there on that line. A little bit further to the right, now we're looking at blue chip stocks, blue chip investments. Look at the stocks in the Dow Jones, the Dow 30. This is companies like DuPont or Apple or Microsoft or 3M, these massive, well-established companies. You're not going to see as much volatility with them because a lot of these are safe haven stocks. They are, well-established companies with a very long track record, but you are going to still see some volatility there because you're owning individual stocks. Beyond that, now you have growth in tech. This is where a lot of people are involved. I am pretty heavy in growth in tech, and so I've exposed myself to a massive amount of volatility here, but the difference being, I don't really care about that. I don't really care what my stocks are doing in the short term. In fact, I don't even really look at them. And that's something we're going to talk about a little bit later, is why you even feel you need to be looking at your portfolio when it's down. And these are the things that a lot of people end up doing. They obsess over their portfolios. They're checking it every, 2 or 3 hours, and it's like, what are you expecting to happen? But anyways, that is where a lot of people are right now, is over here in the growth and tech, and even further over to the right when you have massive upside and massive downside. That is like cryptocurrency, that is pot stocks. That is where most people are right now. They're either in growth and tech, or they're in crypto or pot stocks. and they're exposing themselves to massive amounts of volatility because they are so far out on this risk-reward spectrum. So the simple solution to this is, if you're not comfortable with the volatility you're experiencing within your portfolio, you got to push yourself back that way. If you're experiencing too much and you're in growth and tech, maybe look at buying some blue chip stocks. If the blue chip stocks you're owning are too volatile and you're not comfortable with it, maybe you should become an ETF investor. If even owning ETFs is stressing you out, maybe you should go invest in bonds. And if you just want to be as conservative and safe as possible, go put your money in the bank and watch it do absolutely nothing. But this is exactly what volatility is here. I drew this on the side here. This is basically that pendulum that is talked about in the book The Intelligent Investor by Benjamin Graham. If you guys have not read that book, I'll link up down in the description below where you can grab a copy. One of the best books on investing in the stock market. It's sitting behind us here on my bookshelf. And this is one of these things that Benjamin Graham talks about, is this pendulum here where the market is always swinging between optimism and pessimism. Well, during times of certainty, you're not going to have as drastic of a swing there between optimism and pessimism. But once there's volatility in the market, you're going to see more and more aggressive swinging of that pendulum. And that is why we are seeing more explosive price movements now than ever before. It largely comes down to the fact that there is so much uncertainty within the market. All right, strategy number 2 for investing in 2019 is KISS. I'm sure you guys know what this stands for. Keep it simple, stupid. So many people insist on investing in complicated shit, and I don't really know why this is. It's just like something that seems intriguing or interesting to you. And what I'm going to say is that when you are seeing elevated volatility in the market, like we've seen in 2018 and like we are most likely going to see in 2019, that is not the time to experiment. Unless you have massive risk tolerance and you're only investing what you are willing to lose, I would personally avoid these categories. Now, you can invest in whatever you want to. If you want to go out there and buy pot stocks and crypto and all that, it's completely okay. You can do whatever you want to do. I'm just telling you, this is personally what I am going to be doing in 2019. And I'm not saying that speculation is necessarily wrong. I mean, I've speculated in the past as well, but this is just not the time, in my opinion, to be speculating when you're seeing massive volatility in the market, unless you are some kind of short-term trader and you're profiting off of this volatility. So these are the things that personally I would avoid in 2019. Number 1, IPO investing. Not a fan of IPO investing to begin with. I always like to see a company, have 6 months of activity, of trading activity before I would ever consider investing, just because there is absolutely no price history. And as we've seen with companies like Snapchat and GoPro, IPOs can go completely terrible. So I don't like to invest in IPOs. I've never bought an IPO. I don't plan on doing it in 2019, and I don't think it's a great idea either to do this. Number 2, pot stocks. Unless you really want to speculate here, I would not be investing in pot stocks or cryptocurrency in 2019 just because of the amount of volatility, unless you're just throwing money in there and saying, you know what, if I make money on this, great, but I could lose it all. The other thing would be small cap or micro cap stocks, any kind of penny stocks. I mean, I wouldn't invest in penny stocks regardless, no matter what the market is doing. But even talking about small cap stocks, anything under $1 billion in market cap, personally, I would be avoiding that right now, just because these are not companies that are time tested. These are not companies that are likely profitable. And if we are going to be seeing a shift here in the overall economy, which again, there's no indication we're going to be seeing that, we're just seeing a shift here in the stock market. But if we do see slowing economic growth, and we do eventually see a recession take place, which this is not what we've seen so far. What we've seen here is a correction. Again, I know I'm throwing a lot at you guys here at once here, but there's a big difference between a stock market crash and a stock market correction. And what we're seeing right now is simply a stock market correction that has really little to do with the overall economy. But if you do see the economy begin to tank, you don't really want to be in these areas. You don't want to be investing in these small cap stocks that are not turning a profit, because they are typically heavily leveraged with debt, And it's just not good to have a lot of debt in a tanking economy. And then as far as this goes, speculation as well. If you're already stressed out about the volatility within your portfolio, this would not be the year for speculation. But again, if you're just throwing a couple bucks in cryptocurrencies or pot stocks and you understand that you're all the way out here on that risk reward profile and you're comfortable with that, not a problem with that. But most people, I just think these are not areas you want to be investing in for 2019. Now, on the other hand, what might you want to look at for 2019? Number one, utility stocks. Very safe investment, very consistent investment, simply due to the fact that they are a very boring and consistent investment. Every single month, people pay their utility bills and they pay their gas bills. Otherwise, you get your power shut off. That used to be on my old job. I used to work for National Grid, my power utility, and that was my job. I'd go door to door and shut people's power off when they weren't paying their bills. But as long as you pay your bill on time, everything stays fine, your lights stay on, and you still have, gas for your stove. But most people end up paying their electrical bill. This is a very consistent area for investors. Number two, blue chip stocks. Like we said, these are companies that are well established. Some of them are, decades, if not over a century old, and they've been through it all. So if you are uncertain about the stock market right now and you still want to own individual stocks, maybe take a look at the Dow Jones and look for some blue chip stocks. Beyond that, look for companies with a low debt load and a low price to earnings ratio. I would be avoiding the Netflixes and the Nvidia and the Amazons right now just because of that high PE ratio, and we really have no idea where the bottom is with these stocks. Unless you're looking at like a 5 to 10 year time horizon on these investments and you're not worried about what happens in the short term. Beyond that, consumer staples is a pretty safe area for investors in times of uncertainty. These are your everyday household essentials. Think Procter & Gamble, for example. Healthcare, again, that is a pretty consistent industry to be investing in. That might be a good area to look at as well. And also index funds and bonds. This is the first time in a long time that bonds have actually been paying a yield that's been attractive to investors due to the fact that we are in a rising interest rate environment. And so if you're not comfortable with the volatility that you're seeing with the stock market, maybe what you should do is be investing some of your money into bonds instead of putting more money into the stock market. Because at the end of the day, you have to do something with your money, with your idle cash. If it sits there in the bank, it's being deteriorated by inflation. And so pretty much you got to look at stocks, bonds, real estate, something to do with your money to grow your money. And if you're not liking what's happening within the stock market, maybe consider other investments entirely. But that is what I would do. I would keep it simple. I would say 2019 is not the year for any complicated investments. Okay, and point number 3 is don't shoot yourself in the foot. So many people have already made this mistake. I can't tell you how many comments I've seen on YouTube that I'm just like, I have no words for these people. For example, a lot of people know I'm invested in General Electric stock, and a lot of people know that I am massively underwater on that stock based on the fact that I started buying it at prices that were way too high. But I'm still holding on to that investment, and I believe in that company in the long run. Now, recently on one of my videos I did, somebody commented and they were like, you know what, I've been holding General Electric stock for the last 2 years, finally decided to sell it. And I'm like, there could not be a worse time to sell GE unless we were back in 2008, the last time that this stock was this low. Why somebody would sell a stock when it's at a decade low, the lowest price it's been in the last 10 years, is absolutely beyond me. And if you're somebody who is prone to making mistakes like this, you probably should not be investing in individual stocks because you do not understand the simple concept of how money is made in the stock market. And I'm seeing comment after comment like this of people saying, Apple is doomed, you're an idiot for investing in Apple, or Facebook, you're an idiot for investing in Facebook. And it's like, take a look at the bigger picture. Take a look at what's going on around you. Are people still going to be using Netflix in 2019? Are we still going to order our shit on Amazon in 2019? Are we still going to be going on Facebook or Instagram in 2019? I'm pretty sure the answer to all of these questions is a yes. But people seem to separate the stock from the actual company and look at it as two different things, and you can't do that. As a shareholder, you own a piece of an actual business. And Facebook and Amazon and Netflix, all of these companies, Apple, are still absolutely killing it. In the long run, these companies are going to do amazing things. They're going to continue to see explosive growth. all we're seeing in the short term is a slight difference in what people are willing to pay for them, and everybody seems to think the sky is falling. And it's just absolute insanity to me why people would ever consider selling stocks like Apple or Facebook or Amazon or GE at prices like this. It's just crazy to me. And so that's what I'm talking about right here, is don't be one of these people that's going to shoot yourself in the foot. And if you already shot yourself in the foot, stay out of the stock market. Maybe invest in some index funds or bonds. The stock market might just not be for you. But a couple other points on this. I put together a really good blog article if you guys are kind of uncertain about, the stock market crash versus stock market correction. It's an article called What to Do Before, During, and After a Stock Market Crash. I will link that up in the description below. It's kind of a good guide on, preparing yourself mentally and also what you can do to prepare if you are concerned about a stock market crash on the horizon, which, just so you guys know, I am not concerned about that. I am believing what we're going to be seeing is a correction, and that's about it at this point in time. I want to remind you guys now how money is made in the stock market. How does Warren Buffett make money in the stock market? And it's by buying during a bear market and selling during a bull market. Now, the NASDAQ just rolled over into a bear market. I'm not saying that you need to run out there and start throwing handfuls of cash into the market. I would not do that. But it might be a good time to start dollar cost averaging into some positions here of companies that you've been waiting for to find attractive prices. But just remember, in the stock market, what is right often feels wrong. It feels wrong to be putting money into the market when it's tanking, but that is where people make the money. That is when you make money in the stock market, is buying during a bear and selling during a bull. The other thing I want to tell you guys is focus on a 5 to 10 year time horizon. Where do you think Amazon is going to be in 5 to 10 years? Or JD.com, or Apple, or Facebook, or Microsoft, or Netflix? Where are these companies going? What is the overall trend that we are seeing here with e-commerce or consumption of media? Think about the overall long-term trend, not necessarily all this, short-term noise that we are seeing within the market, and that should help you potentially, weather this storm. The other thing I want to remind you guys is it's not a loss until you sell. Not a loss until you sell. A lot of people are out there saying, I've lost a massive amount of money in the stock market, and it's probably not true, because if you didn't sell your investments, you haven't lost a dime. Once you sell, once you officially pull out that pistol and shoot yourself in the foot, now you have lost that money. But until you do that, you have not lost. The other thing you may want to consider, and this is exactly what I am doing, is dollar cost averaging into the market, and stocks that you're looking to own, begin by taking that small initial position. So let's say, for example, you want to acquire 100 shares of Apple. Well, I would think about maybe buying 10 or 20 shares at a rip over the course of 6 to 12 months or more, just because if that share price continues to fall, you're accumulating shares at a lower and lower price, lowering your cost basis. I would not be funneling massive amounts of money into the market just yet. I would be patient, and I would not be trying to focus on buying at the bottom either. It's impossible to time the market. That's something we talk about in this blog article I'm pointing you guys towards. I would just accumulate shares of companies that you like, and I would do this over a period of maybe 6 to 12 months or maybe even longer. And then the final point I want to leave you guys with is, don't even look at your portfolio. Why are you looking at your portfolio if it's going to be making you feel stressed out and anxious? I understand where people are coming from with this, but I just want to tell you guys flat out, I have not opened my portfolio in the last 6 weeks because there's no point. I know what's in there. I know that I believe in these companies long term. Beyond that, I don't really care what's happening in the short term. And I know a lot of friends of mine that invest in the stock market are like looking at their portfolios every hour, every 2 hours, and it's like, what is the point? What are you expecting to see? Why are you stressing yourself out by saying, oh my gosh, I'm down 20, 30, 40% on these stocks? If you are stressed out about this, again, you're too far over here on that risk reward profile. You got to push yourself back over. And so always leave that option out there available to yourself is, don't even look at your portfolio if it's going to stress you out. Give it a couple months, give it a year, and then see where you're at. Because you got to remember the stock market is a long-term investment. I believe Buffett says anything, investing with a time horizon of less than 5 years is just pure speculation. So if you're investing in stocks and you're hoping to make money in the short term, it's probably not going to be for you. This is probably not the way for you to grow your money. And if you have a 5 to 10 year outlook on your investments, why would you need to be looking at them every single day? Just food for thought there for you guys. But anyways, thank you so much for watching this video. I've been dealing with like some kind of upper respiratory thing for the last week, so I apologize if my voice was kind of off, but I wanted to put this video together for you guys and just kind of shed some light on the psychology of investing in 2019. So thank you guys so much for watching, and I hope to see you in the next video.